Maybe gold is in a bubble, silver's in a bubble. We haven't seen it even pull back anywhere near 50. Anything between 60 and 65, or probably anything under 70, is as good a buy on silver as you're going to get. Once we get through it, silver's headed, $200 an ounce and higher than that. If the Fed hikes rates, it's not necessarily bearish for gold if inflation is rising more than the hikes, because real rates are what drive gold and silver, not nominal rates.
Is this a sign that this gold bull market is still in the early stages?
Yeah, I think it's very significant. So in the alternative, it may be the US central bank that buys the treasuries that foreign central banks are no longer buying. But the whole market is kind of screwed up. I mean, it's all based on perception. I'm serious now about inflation and price stability. But at the end of the day, he's not going to do anything, because if he really decides to get inflation down to 2%, that means he's going to create a massive recession. He's going to cause stocks and real estate and bond prices to crash. He's going to force the US government into major spending cuts or tax hikes.
Is this a buying opportunity, or do you think some caution is warranted here? And in the long term, what do you see the trajectory of the silver market being?
Well, I mean, I think it's going much higher. I think we had a significant breakout at the end of last year, early this year, where silver ramped from like $30 an ounce up to over 120. And then it had a big pullback that kind of coincided with the beginning of the Iran war, and silver pulled back, back below 70, which is where it's trading now. As you said, it's closer to 65. But ever since it blew through 50, it hasn't even come close to that level. So I think that silver, had a major breakout. Clearly, breaking through 50 years of resistance resulted in an overshoot. And now we've back and filled a lot of that overshoot. But I think it is a real breakout. That's why we haven't seen it even pull back anywhere near 50. So I think anything between 60 and 65, or probably anything under 70, long-term probably represents as good a buy on silver as you're going to get. And I think ultimately we're headed a lot higher than that prior peak. It's just, going to take a little time to get back up there. But I think once we get through it, silver's headed, $200 an ounce and higher than that.
And you mentioned the Iran war. I'd love to pick your brain on why both gold and silver fell in the aftermath of that event starting and have largely trended sideways since then.
Markets celebrated silver's pullback, but long-term support never actually broke. Peter Schiff notes that despite extreme volatility, silver has stayed far above the decades-long resistance zone many believed was impenetrable. The overlooked detail is that panic selling failed to reverse the structural breakout. For wealth preservers, failed breakdowns often matter more than spectacular rallies. Next, Peter Schiff reveals why a geopolitical shock pushed metals lower when conventional safe haven logic suggested the opposite outcome.
We've seen an interesting pattern where whenever peace is proposed or apparently on the table, it seems like the metals rise, and when it looks like the war is back on, they fall again. This runs contrary to some people's thinking, where they think precious metals are a safe haven asset. Shouldn't they be skyrocketing while a conflict is going on? Why do you think the price action has played out that way?
Well, first of all, you have to put everything in perspective, because gold and silver rallied so substantially leading up to the war that they were due for a pullback, and the war provided that catalyst. In fact, one of the reasons for the strength was that it was pretty apparent that there was going to be some kind of war, and the market started anticipating that and pricing it in. So by the time the war actually started, it was more of a buy the rumor and then sell the fact. But the thinking that was dominating the markets was that anything that perpetuated the war kept the Fed on hold, kept oil prices high, meant the Fed wouldn't cut rates, meant they might hike rates. And that had the metals on the defensive, because everything is trading off of what they expect the Fed to do with rates. But I think that misses the bigger picture, in that even if the Fed hikes rates, it's not necessarily bearish for gold if inflation is rising more than the hikes, because real rates are what drive gold and silver, not nominal rates. I mean, even if the Fed pushed rates up to 10%, but inflation was 20%, that's a negative 10% yield. that's not an incentive to hold dollars and lose 10% of your purchasing power every year.
The Fed says rates matter most, yet purchasing power keeps telling a different story. According to Peter Schiff, investors became fixated on potential rate hikes, while largely ignoring the inflationary consequences of prolonged conflict and higher energy costs. The contradiction is simple. Nominal rates grab headlines, but real yields determine whether savers actually preserve wealth. Investors focusing only on Fed statements risk missing the larger monetary picture. Next, Peter Schiff exposes why inflation, not war itself, may be the hidden driver behind precious metals demand.
That's an incentive to hold gold and silver instead and retain your purchasing power. So I think once we kind of work off the excess overbought condition we had, we're going higher. And I think eventually we will see a recoupling where investors recognize that war is good for gold and silver, not bad, because war ultimately is inflationary, not the war itself, but the way governments pay for the war, by printing money, by running bigger deficits. And wars also disrupt resources that might otherwise go into the production of consumer goods, and instead they're used for military hardware and things like that. And so during wartime, you have less stuff produced that consumers can buy, and you have more money printed to pay for it. So it's a recipe for inflation, and that's good for gold and silver. It's not bad.
Now, gold surpassed U.S. Treasuries as a reserve asset near the end of last year. A report recently released by the ECB puts this statistic back in the spotlight. How significant is this development in your view? And is this a sign that this gold bull market is still in the early stages?
Yeah, I think it's very significant. And I think the trend is going to continue, and it's going to be very problematic for the United States, because to the extent that central banks prefer gold to dollars, they're not buying treasuries. And if they're not buying treasuries, who's going to buy them? The government has to sell them. And if foreign central banks don't want them, then somebody's going to have to take their place. And in order to get those new buyers, the government may have to offer much higher yields. The problem is we can't afford to pay the higher yields.
Central banks are quietly changing reserve preferences, while most investors remain focused on daily price moves. What Peter Schiff is highlighting is that gold overtaking treasuries as a reserve asset signals a shift in institutional trust, not merely a commodity trend. The uncomfortable question is who absorbs future government debt if official buyers keep stepping back. Savers face the risk of currency dilution if monetary authorities become buyers of last resort. Next, Peter Schiff reveals the inflationary mechanism policymakers rarely acknowledge publicly.
So in the alternative, it may be the U.S. central bank that buys the treasuries that foreign central banks are no longer buying. But that is highly inflationary, because when, let's say, a Polish central bank buys treasuries, it has to use dollars from its reserves. But when the Fed buys treasuries, it creates more dollars out of thin air. So when the Central Bank of Poland buys treasuries, that's not inflationary. But when the Federal Reserve does, it is. And so if the Federal Reserve starts printing all this money to buy the treasuries that other central banks no longer want to buy, the dollar gets killed, prices go through the roof.
The ongoing saga of gold and silver miners barely outperforming the metals continues, with many of them reporting record earnings. Their stocks actually fell as a result. Why do you think this disconnect exists, and what will it take for this trend to reverse in your view?
Investors still don't believe the price of gold. They still expect the price to fall. They think maybe gold is in a bubble, silver's in a bubble. And so they're not willing to price in these higher prices in the long run, which is what drives their valuation of mining stocks. But obviously, at some point, that perception is going to change. I think reality is going to set in, and analysts are going to accept the fact that not only are gold and silver prices not going to come way down, but they're going to keep rising. And then they're going to have to totally redo their earnings forecasts and their valuations of these stocks. But the whole market is kind of screwed up. I mean, it's all based on perception.
The most important monetary shift may occur long before headlines admit it exists. Peter Schiff's argument suggests that if foreign demand for treasuries weakens, central bank balance sheet expansion becomes the politically easier option. Markets continue valuing many miners as though elevated metal prices are temporary despite record profitability. That disconnect leaves investors exposed to a sudden repricing once consensus expectations finally catch up with reality. Next, Peter Schiff exposes why speculative stories command premiums while proven cash flow gets ignored.
Look at the values that investors are ascribing to AI companies. Look at the valuation just placed on SpaceX. SpaceX doesn't even earn any money. SpaceX is still losing money. But investors don't care about that. They're so optimistic on the future that they're willing to pay 100 times revenues just to own a chance that it happens. So they don't want to gamble on gold stocks, even though they're already earning a lot of money. They'd rather gamble on SpaceX that's earning no money. So it's just a perception. But at some point, investors are going to look towards the certainty of precious metals miners as being more valuable than just rolling the dice on a company like SpaceX.
Yeah, I want to get into the SpaceX IPO in just a moment, but first I'd like to ask, where would you be positioned in the gold and silver miners here? Is this a time when you want to own the biggest and the best producers, maybe the ETFs, obviously exposure to physical gold as well, or would you be going further out on the risk spectrum into the developers and the explorers?
Well, I like to buy individual names and I like to do research, and I think there's a lot of inefficiencies in the space. The best and brightest analysts are not necessarily assigned to metals and mining. So if you've got a good portfolio manager, if you got a good guy, he generally has a leg up. So rather than just buying everything, I'd rather be selective, buy what looks cheap and promising, and avoid what looks expensive and just too big of a crapshoot. But there's a lot of opportunities, obviously, not only in the big companies and the mid tiers.
Investors routinely pay extraordinary valuations for future possibilities, while discounting businesses generating cash today. This is where Peter Schiff's thesis shifts from macroeconomics to market psychology, highlighting how narrative often overwhelms fundamentals. The overlooked risk is chasing fashionable sectors after optimism is already fully priced in. For long-term capital preservation, selective ownership of undervalued assets can matter more than following momentum-driven excitement. Next, Peter Schiff unravels why speculative capital could eventually flood into overlooked mining shares.
But a lot of these junior companies, I think, at some point they're going to be worth a lot more, even if they don't develop to the extent that we hope that they will, because at some point investors will be more willing to speculate in this sector. And when the hot money comes in, prices are going way up. So, it's a great opportunity to be invested now.
Well, I want to turn to the economy and read one of your recent tweets. You wrote, in May, the U.S. government spent $628 billion, yet collected just $335 billion in taxes. That means that balancing the budget would require taxes to almost double. Since that won't happen, massive money printing will cover the shortfall, sending consumer prices doubling instead. Now, if you expect this level of inflation up ahead, what could that do to the middle class in America? And is one of the remedies here physical gold and silver to protect purchasing power?
Look, the middle class is getting wiped out. I mean, that's what's happening. That's why the consumer confidence numbers are at record lows. That's why Trump's popularity is at a record low. That's where the affordability crisis is coming from. People can't afford things. It's not because the things are more expensive. It's because the people are poor. And the reason they're poor is because the government took their purchasing power. It robbed them through inflation to cover all this spending. We have at least 50% more government now than we had before COVID, but taxes have been cut. So how are we getting all this government? I mean, it's not free. And so every time you go to the store to buy something, those higher prices are how you're paying for government.
The affordability crisis may be less about prices rising and more about purchasing power falling. Peter Schiff notes that government spending continues vastly exceeding tax receipts, creating a gap policymakers appear unwilling to close through conventional means. The hidden consequence is that inflation functions like a tax most visible to households living paycheck to paycheck. Wealth protection becomes critical when currency debasement quietly erodes real living standards. Next, Peter Schiff reveals why inflation impacts different economic classes in dramatically different ways.
Now, there are some people, that benefit from inflation because they own a lot of assets that are also being inflated. And it doesn't matter to them that their food is more expensive, that their gas is more expensive, because those are small expenditures in the scheme of things. But when you're living paycheck to paycheck and you're spending a good chunk of your money on the necessities of life, when those necessities go way up in price, it is a big deal for you. And that's what's happening. The middle class is basically disappearing, or what's left of it, because we've been, basically eviscerating the middle class for decades now.
You mentioned the Fed earlier in our conversation. What do you think about new Fed Chair Kevin Warsh? At the last FOMC meeting, rates were left unchanged. Warsh gave a little speech. Is this just a case of meet the new boss, same as the old, or is this guy really going to shake things up and do anything good in your view?
I don't think he's going to shake anything up. I don't think he's going to do anything. I just think he's talking now to try to come in with some credibility. Hey, new sheriff in town. I'm going to clean up the streets, right? I mean, you guys better watch it. I'm serious now about inflation and price stability. But at the end of the day, he's not going to do anything, because if he really decides to get inflation down to 2%, that means he's going to create a massive recession. He's going to cause stocks and real estate and bond prices to crash.
Markets celebrate asset inflation, yet millions experience it as a decline in living standards. According to Peter Schiff, policymakers face a dilemma where genuinely defeating inflation could require accepting painful economic contractions and falling asset prices. The contradiction is that leaders often promise price stability while avoiding the policies necessary to achieve it. Investors relying solely on official assurances may underestimate future monetary accommodation. Next, Peter Schiff exposes the political reality that may outweigh every inflation-fighting promise.
He's going to force the U.S. government into major spending cuts or tax hikes. He could easily precipitate another financial crisis. A lot of bad things are going to happen in order to achieve that objective. And at the end of the day, I don't think he's going to do it. I don't think he has the guts to do it. He's going to do what Powell did. He's going to do what Yellen did, what Bernanke did, what Greenspan did. He's going to print money. He's going to create inflation. He said inflation is a choice, and he's right. His predecessors chose inflation, and he's going to make the same choice, because making the opposite choice is politically a non-starter. And can you imagine? I mean, Trump just laid into Powell for what he did. Imagine what he would have to say if Warsh just started hiking rates like aggressively and started shrinking the balance sheet, and mortgage rates were going up, and housing prices were falling, and we were in a recession, and he kept tightening. I mean, what the hell would Trump be doing in those circumstances?
We talked about SpaceX. I'd love to get your views more broadly on the big three indices and the level of overvaluation that we're seeing there by any number of metrics. I mean, pick whatever you want: Shiller PE ratio, Buffett indicator, price to sales, price to book, etc. We're at historically stretched valuations, and yet the market seems to keep grinding higher. Do you think we are due for a large correction and perhaps longer sustained bear market in the big tech stocks up ahead? And what are your overall thoughts on the broad market right now?
Well, look, the market is as overvalued as it's ever been.
The biggest risk may not be inflation itself, but the political incentives surrounding it. What Peter Schiff is highlighting is that aggressive inflation control would likely trigger consequences elected officials find nearly impossible to tolerate. Markets continue pricing assets as though monetary support can remain available indefinitely without costs. For investors, that assumption deserves scrutiny, because policy choices often follow political realities rather than economic ideals. Next, Peter Schiff reveals why today's valuations resemble classic bubble conditions despite widespread confidence.
So unless you're in the this time it really is different camp, which is always a very dangerous camp to be in, and you end up losing a lot of money if you're in that camp. I'm not. I think that a bubble is a bubble, and if it walks like a bubble and quacks like a bubble, right? And so we got a bubble in AI, no question about it. We got a bubble in tech. But, we really have a bubble in everything. Everything that's affected by interest rates and cheap money seems to be overpriced, except for the mining stocks and precious metals. The only thing that seems not to be in a bubble is the stuff that I own. And I think the bursting of the crypto bubble, because that bubble has for sure burst. All the air hasn't come out yet because a lot of people don't recognize the fact that A, it was a bubble, and B, that it burst. But if you look at MicroStrategy, which is just getting killed, trading at like a 20 or 25% discount to its Bitcoin. If you look at his preferred stretch, trading for more than 10% below par. Strategy now for 3 weeks in a row has deliberately destroyed shareholder value by selling its stock despite the discount and then buying more Bitcoin, which is an asinine thing to do because you're actually reducing the Bitcoin per share. So MicroStrategy shareholders are worse off because they bought the Bitcoin, because they actually own less Bitcoin after the buy than they owned before it. So why would he do something like that? It's a desperate move to try to prop up the price of Bitcoin.
Every major bubble eventually reaches the stage where participants insist traditional valuation metrics no longer apply. Peter Schiff's argument suggests that years of cheap money distorted pricing across multiple asset classes, leaving investors vulnerable to painful mean reversion. The warning sign is not enthusiasm itself, but the growing gap between underlying fundamentals and market expectations. Wealth preservation often begins by recognizing excess before consensus finally acknowledges it. Next, Peter Schiff exposes the behavior that may signal desperation rather than confidence.
Because he's the buyer and he's willing to buy Bitcoin even if he has to destroy the value for his own shareholders in the process. So this is done, right? Put a fork in it. It is done. But to me, the fact that the most crazy bubble of all bubbles, crypto bubble isn't necessarily the biggest bubble, but it is the most insane and the most irrational, because most bubbles start with something and then it just becomes excessive. Bitcoin and crypto start with nothing. It's all sizzle. There's no stake. At least SpaceX has a stake there somewhere.
When an asset requires increasingly aggressive support mechanisms, investors should ask what that support is trying to prevent. This is where Peter Schiff's thesis shifts towards sustainability, questioning whether demand remains organic once financial engineering becomes necessary. The deeper issue is not volatility, but whether underlying value can justify expectations during a prolonged downturn. Long-term investors must separate compelling narratives from durable fundamentals.